So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We are going to be going through fundamentals and technicals as usual. I would be also minding here that we're going to be focusing mostly on FX pairs. And we will be using mostly the daily chart unless otherwise stated. Should you have any trading instruments you would like us to have a look at, feel free to add them in the comment section, and if we have the time, definitely we'll have a look at them. If not, we can always have a look at them tomorrow. Starting with Euro USD, bearish tendencies practically since Friday were maintained in today's Asian and early European session, albeit we have to note at a low extent, smaller extent than on Friday. Nevertheless, the price action of the pair seems to have breached the 1.07 support line. So that definitely has to be turned into resistance line. And sorry. Let's go hunting for a new ultimate support level. A clear-cut show here. In green. At 1.0220, let's widen, readjust the chart, narrow it, and let's correct the levels, starting with the S3, which is now being placed at 1.0220. The S2 at 1.0440. The S1 at 1.0565. The R1 at 1.0700. The R2 at 1.0930. And the R3 at 1.1070. Locking everything in. So we tend to see the case for the fact that the price action has breached the S1 1.07 and turned into resistance line as an indication of a bearish tendency for the pair. Similarly, also the RSI indicators between the readings of 50 and 30 and aiming for lower grounds, implying that the bearish sentiment is turning increasingly bearish for the pair. So more or less we see the case for the bearish tendencies to be maintained. One small word of caution here. I would note that on a technical level, the price action has breached below the lower Bollinger Band, which may be a reason for a correction higher of the pair's price action. Now, should the bears maintain control, I wouldn't be surprised to see them making the next stop at the 1.0565. For a bullish outlook, I say such an outlook for the time being is remote. I would require the pair to rise, breach the 1.07 resistance line, and aim, if not breach, also the R2 1.0930. Now, besides the pre-mentioned, let's have a look at the fundamentals of the two sides of the pair. Starting with the Euro side, now the case for Euro bulls becomes fundamentally harder by the day. And I'm focusing this because We have political instability in Germany, given that we saw practically German Chancellor Scholz firing the finance minister Lindner. Now, Mr. Lindner, though, was also the leader of the Liberal Party, which was one of the three coalition parties of the traffic light government in Germany. It's understandable that the German government has lost a majority in the German parliament, the Bundestag. So I wouldn't be surprised saying a motion of confidence vote, if you prefer, for the German government being set could be even earlier than Christmas. And in such a case, we may see the Social Democrats or the governing parties, the Greens and the SPD, losing the vote. In that case, we may be having elections by the end of January, if not earlier. So there is a political instability in a manner of voting, or if you prefer, majority of the government within the parliament. But in my opinion, there is a deeper qualitative issue which tends to pass unnoticed, and that's the fact that the Germans are having a hard time actually agreeing on the new budget. We're talking about a period where the German government wants to boost the economy by fiscal spending. However, the constitution of Germany does not allow the German government to actually remain or bring the deficit up to a level. So there may be no practically budget deficit. So that's an issue which it's going to be difficult for the Germans to overcome. I see that you have a question about the possible elections and the outcome. Okay, it's too early. But probably we may see the center-right party, the Christian Democrats, coming in first. Who follows is a different story. The case of a grand coalition, though, is being widely discussed in Germany as to provide stability. Now, on the USD side of the pair, in my opinion, okay, besides the election of Trump, that was yesterday's news, but it's still affecting the markets. May I add here that we may be seeing Trump trades being somewhat doubted. So I would be focusing mostly on the Fed's interest rate decision on Thursday. The Fed's interest rate decision was a tad bit more hawkish than expected. And I'm noticing this because practically the line in which, in the bank's forward guidance, in which the Fed had more or less expressed its confidence that inflation is to continue slowing down and near the bank's 2% target, that was erased. Now, other than that, or let me recalibrate it. So practically, we see the case for Euro bears and at the same time USD bulls, which could allow for a more clear-cut bearish outlook to emerge over the coming week. May I also add here that we're getting the next big test for the US dollar, which is going to be October CPI rates. And a possible acceleration could more or less enhance market expectations for the Fed to pause its rate hiking path in the December meeting, if not definitely in the January meeting. Now, I had a suggestion here, and I tend to agree with this, is that the pair is in need for a wider calibration, in my opinion. So let's do this. Starting with the R3, I'm going to be setting it at 1.1215. The peaks are very clear here, and could go at 1.10 actually. Yep. Setting this true as the next level, which would be at 1.10. Next is a support line on this true here at 1.0755. Would be hiding and raising a bit the S1 to reach this true here, 1.06. And let's recheck the S2 and the S3. The S2 definitely has a valid touch, so we keep that. And the S3. Okay, that's it. Locking everything in. So we maintain a bearish outlook for the pair and set the next possible target for the bears at 1.06. Let's have a look at USD/JPY. We could lower just a tad bit the S1 at 151.30. Now there are two ways of thinking of this. The one is that there's still an upward motion here in play, which could be valid, especially if we on the other hand, let me extend this a little bit. There are some tendencies of stabilization, or at least a hesitancy on behalf of USD/JPY bulls to actually lead the pair higher. Let's readjust also the support line labels. So it's a question here. Are we favoring an upward motion, which is being based practically on the upward trend line, or are we favoring a sideways motion? Now, we have to decide, and I would be setting in the factors behind the decision for the bullish outlook to be maintained we would require a higher peak than this one. So the price action has to breach above the 154.80 and start aiming for the R2 158.35. On the flip side, should the pair remain within the boundaries set between the R1 and the S1 and break at the same time the upward trend line, that would be an indication, in my opinion, a clear indication that the upward movement has been interrupted and the time to switch the bullish outlook in favor of initially a sideways movement bias. For a bearish outlook, I would require the pair to breach the pre-mentioned upward trend line exactly in the first signal that the upward movement has been interrupted, but also breach the S1 151.30 and start aiming for the S2 149.10. Let's have a look at GBP/USD. Now here the situation is more clear. We have discussed already the fundamentals regarding the US dollar. Allow me also to discuss now the fundamentals on the GBP side of the pair. And for pound traders, I would be highlighting tomorrow during the early European session the release of UK's employment data. The unemployment rate was expected on Friday to tick up to 4.1% if compared to August's 4%. However, that is no longer the case, and the unemployment rate is expected to remain unchanged at 4% currently. The big question, in my opinion, though, is the employment change figure. In the previous report, we had an employment change figure of, if I'm correct, 373,000 jobs, which I think is going to be difficult for the UK employment market to top it tomorrow for September. So there may be some disappointment there, which could weigh on the pound. Yet I would be highlighting also the release of UK GDP rates on Friday, especially the quote-unquote rate, and should the rate slow down, then we may see market worries about the pound being enhanced near the end of the week. For the time being, on a technical level, as mentioned, we maintain a sideways motion bias between the S1 and the R1. Yet I would be noting also at the same time that the RSI indicator remains stubbornly below the reading of 50, which tends to imply a slight bearish predisposition on behalf of the market for the pair. Now, should the bears take over, or if you prefer for bearish outlook, we would require the pair to break the S1 1.2845 clearly and start aiming for the S2 1.2675. For a bullish outlook, now the pair would have to practically recover all the losses of Friday and also breach the R1 1.3040, thus paving the way, or if you prefer, opening the gates for the R2 1.3260. Okay, let's have a look at USD CAD. Also in sideways motion between the, let me adjust the labels just a bit, between the R1 1.3945 and the S2 1.3720 and the S3 1.3610. Now the sideways motion is clearly being defined by the movement, the roller coaster movement of USD CAD. That's something which we will see also in the oscillator on. And on the lower bound of the range bound movement is the S1 1.3820, while on the upper boundary it's the R1 1.3945. We tend to maintain a bias for the sideways motion to be maintained as long as the two levels are being respected. Should the bulls take over, I wouldn't be surprised to see the price action breaching the R1 1.3945 and start aiming for the R2 1.4115. On the flip side, should the bears take over, we may see the pair dropping practically, rendering back any gains it had made on Friday, breaching the S1 1.3820 and start aiming 100 pips lower for the S2 1.3720. Let's have a look at the Aussie. Readjusting the labels. So we maintain a sideways motion bias between the S1 0.6555 and the R1 this year 0.6705. Could go a little bit lower with the R1, but I prefer to keep it given the context it had in the past. Anyways, maybe the Aussie was the clearest roller coaster ride among commodity currencies against the US dollar. And I would be noting that on the fundamentals today, we expect practically Aussie traders to continue focusing on China, given the close Sino-Australian economic ties. Australia is exporting a wide amount of raw materials to China. It's practically feeding China's manufacturing sector with raw materials. The worrying part is, or if you prefer, was the release of China's inflation metrics for October on Saturday. Now, the CPI rate, that's the inflation on consumer level, slowed down, while on a producer level, it contracted even deeper. And the release is not so much of an encouraging sign for the recovery of the Chinese economy. On the contrary, it's actually quite worrying. And especially if you take in mind that during October, the Chinese government had provided a substantial fiscal stimulus package. And at the end of September, the People's Bank of China may have provided the most aggressive post-pandemic stimulus package as well. So it's a big issue in the following sense that if the Chinese economy was not able to recover, pick up economic activity, raise its prices once the stimuluses were out, what's it going to take for the Chinese economy to recover? By the way, more clues about this question we are going to be getting on Friday, as we're getting China's industrial output growth rate, urban investment growth rate, and retail sales growth rate. The first two are crucial practically for the supply side of the Chinese economy, while on the flip side, the retail sales is a crucial indicator for the demand side of the Chinese economy. Yet also traders may also be interested in other releases, as we have Australia's employment data, if I'm correct, on Thursday's Asian session. And should we see signs that the Australian employment market remains tight, that could encourage more or less RBA to remain in a hawkish stance, maintaining rates high for longer. It may not hike even further, but it could keep the rates high for longer. And practically that would imply that interest rate differentials with other large central banks would be favoring the Aussie and could provide support for the Aussie. On the flip side, should the Australian employment market show further loosening or slack, that could imply more or less that the chances for RBA to ease on its hawkish stance are increasing. Now, on technical level, we have mentioned that for a bearish outlook, we would require the pair to drop below the S1 0.6555 and start aiming for the S2 0.6470. On the flip side, a bullish outlook may occur, but the bar is very high. The price action would have to breach the R1 0.6705 and start aiming for the R2 0.6820. For the time being, and as long as the price action remains between the pre-mentioned levels, we tend to maintain a bias for a sideways motion to be maintained. There may be some slight bearish tendencies based on the RSI indicator, which is currently at 44, 43. More or less, that tends to imply some slight bearish predisposition, but for the time being, in my opinion, remains unconvincing. I would require a clear break of the R1 and the price action to start aiming, if not even testing, the S2 0.6470 before adopting a bearish outlook for the pair. Let's have a look at gold's price. Gold corrected lower even further today, and here it is. Now definitely the S1 has to be reversed and be set into a resistance line. Let's go hunting for a new ultimate resistance support level, and I think we got it right here. A beautiful true. Let's color this in green. R3 is now being set at 2,900. The R2 at 2,790, which is the record high practically for the precious metals price. The R1 at 2,685. The S1 at 2,600. The S2 at 2,470. And the S3 at 2,355. Locking everything in. We definitely saw how the upward trend line, which has been guiding the precious metals price since around the last days of July right here. Now that upward trend line has been broken. So we switch initially our bullish outlook in favor of a sideways movement bias. I would require for a bearish outlook, despite bearish tendencies being in play. You can see how we have lower peaks forming. I would require another lower true below this one. So the price action has to reach the S1 2600 before bearish outlook is announced. Even should the price action of gold breach the S1 2600, that would provide me with far more confidence about the bearish outlook of the precious metals price. On the flip side, should the bulls take over, the bar is high, the price action would have to breach the R1 2685, but also breached the 2,790, practically forming a new record high. On the fundamental side for gold's price, I would be noting that we see elements of a resurgence of the negative correlation between the US dollar and gold's price. It's characteristic that the US dollar index has been rising on Friday and today, while at the same time that strengthening of the US dollar seems to be weighing on gold's price, as gold's price has been falling on Friday and today. The catch is that the movements are not of the same extent. It's as if the US dollar is overstretching itself to the upside in order to push gold slightly lower. That should sum it up for the day from all of us here at IronFX. Best wishes for solid trading.
So, as per usual, before we get started, just a risk warning. So, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. Um so firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long biased traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. So you can see here, our sell side is on the bottom where the swing lows are. Buy side is where the swing highs are. So basically, it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here. which have large real bodies, very short wicks, like you can see here. And that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of the candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay, sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. if we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Um, yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have um higher lows, or rather lower highs, since it's a downtrend. Okay, so next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels, or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my, let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. Shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as, we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so our prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my. Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw it, your starting point here, and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. Flip zones and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity gaps, which we went through before, are basically the areas in which there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at DXY, just a random chart, how you basically implement the FVG indicator. Okay, is okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. So you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just gonna share all the resources that we use. Um, so basically what I mean by a double fair value gap. So you can look at this website as well. Um, but basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your BPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, yeah, to my chart here. So you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix-up. But yeah, let me know if you have any other questions. Yeah, with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week, we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix-up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.